Hey, welcome back. If you're new here, this channel is all about helping you understand crypto the right way before you put your money in it. Hit that subscribe button because today's video is one of the most important things I will ever teach you on this channel. We are talking about risk management. And I know what some of you are thinking. That sounds boring. I just want to know what to buy. But here is the truth. The traders who make money long term are not the ones who find the best coins. They are the ones who know how to protect their money when things go wrong. And in crypto, things go wrong. A lot. Bitcoin can drop 20% in a week. A coin you believe in can lose half its value overnight because of one news headline. A trade that looks perfect can reverse on you in minutes. It is not about whether bad trades will happen, they will happen to everyone. The question is whether you survive them or whether they wipe you out. That is what risk management is. It is the system that keeps you in the game long enough to actually win. Today I am giving you three rules. These are not complicated, but if you apply all three of them consistently, they will completely change your results. Let us get into it. Never risk more than 2% per trade. Rule number one. Never risk more than 2% of your total trading capital on a single trade. This is called the 2% rule, and it is the foundation of professional risk management. It is used by hedge funds, professional traders, and anyone who has been in the markets long enough to understand what survival actually means. Let me show you exactly what this looks like with real numbers. You have $500 to trade. 2% of $500 is $10. That means on any single trade, the most you should be willing to lose is $10. You have $1,000. 2% is $20. Maximum loss per trade is $20. You have $5,000. 2% is $100. Maximum loss per trade is $100. Now I know what some of you are thinking. That seems like such a small amount. How am I supposed to grow my account risking only $20 at a time? Here is the answer. Slowly, consistently, and without blowing up. Let me show you why this rule is so powerful with math. Imagine you ignore this rule and you risk 20% of your account on a trade because you are really confident. You lose. Now you are down 20%. To get back to where you started, you need to make 25%, not 20%, because you are working from a smaller base now. Do that a few times and your account is gone. Now imagine you follow the 2% rule, you have a bad stretch and you lose 10 trades in a row. That is a genuinely terrible run, but you have only lost about 18% of your account total. You are still in the game. You still have money to trade with. You can recover. The 2% rule is not about limiting your upside. It is about making sure a losing streak, which every trader has, does not end your trading career. Write this down. Small losses are a cost of doing business. Large losses are a threat to your survival. Always set a stop loss before you enter. Rule number two. Every single trade needs a stop loss set before you click buy. A stop loss is an automatic exit order. You tell the exchange, if this trade goes against me and the price falls to this level, close my position automatically and take me out. It removes emotion from the equation entirely, and that matters more than most beginners realize. Here is what happens without a stop loss. You enter a trade, the price starts dropping, you tell yourself it will come back. It keeps dropping. Now you're down 15% and you are frozen because selling feels like admitting you were wrong. It drops more. Now you are down 30% and the loss is so large that selling feels pointless. So you hold, and sometimes it never comes back. This is called letting a loser run, and it is one of the most common ways beginners destroy their accounts. Not from one catastrophic trade, but from one trade that slowly bleeds them dry because they never had a planned exit. A stop loss solves this completely. You decide before you enter how much you are willing to lose on this trade. You set the stop loss at that level. If it hits, you are out automatically. No hesitation, no emotion, no hoping. Now here is how to actually place a stop loss properly. Most beginners set their stop loss too tight. They buy Bitcoin at $40,000 and set a stop loss at $39,500. That is 1.25% below their entry. Bitcoin sneezes and they get stopped out immediately, even if the overall trend is still up. A good rule of thumb for beginners is to set your stop loss at a level where if the price reaches it, your original reason for entering the trade is clearly wrong. This is usually a key support level below your entry or a percentage that makes sense given how volatile that particular coin is. The exact level will vary, but the non-negotiable part is this: there must always be a stop loss. Every trade, no exceptions. If you're not willing to set a stop loss, you are not ready to take that trade. Never let one trade define your account. Rule number 3. Never put so much into one trade that losing it would devastate you emotionally or financially. This is about position sizing, and it connects directly to rule number 1. But I want to go deeper here because this is where I see even intermediate traders make mistakes. There is a specific trap that happens in crypto. A coin starts moving fast. The chart looks perfect. Someone you follow online is talking about it. Everything feels aligned. And instead of following your plan, you go heavy. You put 30, 40, 50% of your account into this one trade because you are so convinced it is going to work. And sometimes it does work. And that feels amazing. And it makes the next time even more tempting. But eventually, it does not work. And when 50% of your account is in one trade that goes against you, the psychological damage is severe. You start making desperate decisions to try to recover. You overtrade, you take revenge trades, and that is usually when accounts fall apart completely. The solution is simple. No single trade should ever be so large that losing it would change how you think or how you trade. Here is a practical framework. Think of your portfolio in buckets. The majority of your money, let's say 70 to 80%, stays in your core holdings. These are your Bitcoin and Ethereum, your long-term positions that you are not actively trading. The remaining 20 to 30% is your active trading capital. This is the money you use to take trades. And within that trading capital, each individual trade follows the 2% rule we talked about in rule number 1. This structure means that even if all your active trades go wrong, your core holdings are untouched. You have not lost everything. You are still in the game. One trade is never the whole story. The market will always give you another opportunity, but only if you have money left to take it. Let me bring this together quickly. Rule number 1. Never risk more than 2% of your total capital on a single trade. Small losses are survivable. Large losses are not. Rule number 2. Always set a stop loss before you enter any trade. Decide how much you are willing to lose before you are in the trade, not after. Rule number 3. Never let one trade define your account. Size your positions so that no single loss can devastate you emotionally or financially. These 3 rules will not make every trade a winner. Nothing can do that. But they will keep you in the game long enough to get better, to learn, and to eventually come out ahead. If this video helped you, please hit the like button and subscribe.